Good evening and welcome to PBS here in Fort Wayne. I'm Sandy Thomson, the host of the show Life Ahead. But you're the audience and you're really what it's all about. This show, if it's the first time you've ever watched it, we have different topics each week and guests that are professionals in the field of topics that we have here. And we have a different topic every week, so you got to keep watching and maybe we'll have something that interests you. And I will say that most of the things that we talk about are either something that you've had to deal with or eventually will. So our hope then is to give you some information and education for choices that you might have to make in your Life Ahead. That's the name of the show. And you can call us. You see the number on the bottom of the screen, 969-2720. We're going to be talking about taxes tonight. I'm sure most of you out there are starting to think about it if you haven't done them already. I don't know a lot of people that are finished, but maybe you are much more conscious about that. But a lot of people are at least gathering the materials and getting ready to do their taxes. And this is a good opportunity for you to call and talk to a tax expert tonight and a legal expert. Please meet, if you haven't watched us enough, you would know Heidi Adair. Heidi, thank you for coming tonight so much.
Thanks for having me.
And at tax time, Heidi is the attorney, by the way, specializing in elder law. But each year at tax time, you bring Cindy Wirtner on with you. Mm-hmm. She's the tax accountant. What's your official title?
I'm a CPA.
CPA, okay.
Yeah.
All right, so she's the one that's going to know the specific tax questions that you have. And then if we move on to a legal issue connected with that or whatever, then we're going to refer you to Heidi. Okay, enough about the rules of the show. Yeah. No commercials. We go straight through this half hour. Let's start with you, Heidi. Taxes are such a big thing, but they're all involved in some way with our estate. What estate documents have to do with taxes, or what should we be keeping?
It's the reason that I like to do a tax show is that I think it's that time of the year when you just kind of get everything together and organized, and you start, thinking about projects that, other than your taxes, that you should be working to accomplish. So you just want to make sure you've at least got some basic estate planning documents in place. Like a healthcare representative appointment, naming who can make healthcare decisions for you, a power of attorney who can help you with financial matters, getting your taxes done if you are incapacitated, a basic will that says where you want your things to go.
Well, it's interesting and no surprise that you would give that answer because, and we've talked about this in past years, it is, I think, maybe we get through the holidays, we just kind of only do what we have to do because we're really getting ready for the holidays, and we put everything off. It's like after New Year's or in January I'll get around to this, and it is this early part of the year, January, February, March, when we start dragging out the folders that we've had invoices and financial information in, and start to get ready for doing taxes. But as you said, a good time to think, okay, now wait a minute, I need to address this as well now that I'm looking at all of the business parts of my life.
Right. And it's to do estate planning, it's great to have a listing of assets. And while you're, all your assets are kind of flashing before your eyes while you're doing your taxes, it's a good time to just pull that list together.
Okay. All right. Cindy, do you find this happens with your clients? Do they come to you with just taxes, or are they coming to you with like their whole package of receipts and invoices and assets?
They come mostly with taxes. Some of them come with boxes, and that's always joyful when a Xerox box comes. But there are some people who are dealing with a trust or an estate, and it's kind of a new animal for them. And oftentimes when they're dealing with an estate, they've lost somebody near and dear to themselves, so there's that emotional aspect. So they need a little bit more care, I think. And if they want to, I'd rather have them bring too much than not enough.
And if they are coming to you as a CPA to help handle somebody's taxes that's passed away in the past year, it is an emotional thing. Plus, you're dealing with somebody else's life that you only know about through the papers they have. I mean, you know about their daily life, but as far as things that you need to know for taxes, they just have gone through mom or grandma's, file cabinet and pulled out a bunch of stuff and said, "Here,
Yeah.
you take care of it."
Yeah,
You
but
take care of it.
mostly people have their own tax situation to think about.
Sure.
So they know what kind of documents they need, and they can kind of equate that to what mom or dad or grandma might need. So that's a little bit different.
Okay, you hinted at it, but let me ask the question. Do people seriously bring in a box of like receipts and miscellaneous papers and a napkin with something scribbled on it and dump it on your desk and say, "Do my taxes"?
I haven't seen napkins lately, but I have had people bring, it's a thing of mine, everything comes in an envelope. It says tax documents saved.
Right.
So a lot of people will unfold the document, look at it, and then fold it back up and put it in the envelope. And that drives me nuts because, it's out. I need to see it, but they'll put it very carefully. Information.
So if you're just given that envelope, you don't even know what the topic is or what it's about.
Well, usually it'll say tax information.
Oh, I
And then-
know. I get those. I know what
Yeah.
you mean. But it doesn't say this has to do with my IRA or this doesn't have to do with my part-time job or anything. It just is an envelope
Well, I
with
know
a
I know
window.
the forms. I
Okay.
mean, I know by the forms for what to expect. So
I take my things out of the envelope.
thank you.
You're very welcome. I feel appreciated now.
Your accountant loves you.
And I have them, all organized. And then I try to organize them into the categories of what's what. And then I put a little post-it note at the top of, this is, 1099 for whatever, try to make it simpler. So you're very welcome. Hey, we have a phone call already, and I knew we would have some here. This phone call, by the way, is from Bays, and Bays says, if your loved one dies in the middle of the year, do you have to file taxes for them? All right, Heidi, you talk about this.
Yeah, so it just kind of depends on how much income they had before they passed away. If you're in the middle of the year, in June, you very well may have earned enough income that you have to file an income tax return. So you should continue to gather up 1099s, talk with the tax preparer, and figure out whether a return is owed or not.
And it may not be from a job. It might just be income derived from investments.
Right.
Dividends
Right.
or interest or whatever.
Correct.
I know Heidi addressed this issue one other time when we were talking about taxes. And share with them, Heidi, you told us something very interesting about the time of year when you die and what that has to do with how long it takes to settle an estate.
Oh, okay.
Remember that?
Yeah, I
Okay.
remember. So if you pass away in December, your family can usually wrap up your estate fairly quickly.
Why?
Because your income is done with that year, and you've got your April filing deadline, and after that there's no more income for you.
So you already have all your W-2s or 1099s, all those
Right.
are going to be there because it's the end of the year.
Right.
But
But if you die in June, we kind of got to usually wait till spring of the next year to make,
Right.
make
Before
sure
you
we get the
can-
taxes done.
okay, all right. Not that we're suggesting any of you
Yeah.
put a date on your calendar by
Yeah.
any means, but if you're getting very frustrated because you think the estate hasn't been completed yet and handled, that could be one of the reasons. And,
Right.
and I know that you think it can be done and your estate settled in a couple of weeks. Not the case. What's a typical time?
Oh, our goal is always to get done in under a year.
Okay.
So, or a year. I mean, we consider that successful. Sometimes we can be done quicker than that if there's just not a lot going on. So sometimes it takes longer.
And, from discussions we've had or I've had with some of your colleagues, they say it might also have to do with your assets, or can you
Right.
get a hold of different people that are all over the country nowadays?
Right.
A lot
Yep.
of things.
Yep. That, and coming to an agreement on selling a piece of real estate. Maybe some people in the family want to fix some things up before the sale happens. Some people don't want to fix up. So you got to work through all of those. Somebody in the family may want to buy it and they need to work on trying to get a loan lined up. Those things just take time.
Got it. Understand. Okay, all right. If you're getting all of your receipts and everything in line and ready to do your taxes, Cindy, give us some tips. What are some of the most common mistakes, errors, whatever, that people do when they're doing their taxes?
Well, first of all, you have to make sure you have all your documents with you. And a lot of tax preparers will have you work on a questionnaire and ask you things like, did your marital status change during the year? Did you buy a house or sell a house? Did you invest in something?
Yeah.
And that gives us a clue that there might be paperwork involved in taxes that you may not have known had a tax significance to it. So we go through that. Common mistakes I see a lot this week, actually. Indiana has a deduction for real estate taxes paid.
Yes,
and people forget to bring that document.
So they should bring a copy of their property tax. They're not going to get another new one. They have to keep the original one they got.
But the thing is, I can look at that online. There is, so
that's
I can
right.
retrieve
That's
it
public
online.
information.
But
Yeah.
what I found lately, unfortunately for some clients, I've found that they forgot to make their November payment. So I have the joyful job of telling them that they're delinquent, and maybe they better look at that, for some reason. I mean, we've all forgotten deadlines, so that's happened a lot lately. And then I had somebody who was a self-preparer for years and didn't even know that was a deduction.
Really?
It's it can save you.
It's so complex.
Yeah.
What is it? Homestead deduction?
Well, that's
what I'm thinking about.
That reduces your the assessed value of your house, so your real estate taxes are lower if you have a homestead deduction. But that's not income taxes.
Okay,
but
got it. I understand what you're saying though about how easy it is to forget. I mean, when I get the tax statement, spring and fall, and I put it in my written calendar because I could very easily forget if I stuck that in the mail slot here in the kitchen, with everything else.
Yep.
It's easy to forget when November rolls around that was due. Is there a penalty in your taxes at all, or you just have to run and pay it real quick? What happens?
Oh yeah, Allen County assesses a penalty if you're late.
Okay.
Yeah.
And then do you have to report that on the taxes?
No, and it's not deductible either. Only the tax, right? Penalties are not deductible. If you have a long haul trucker that he says a speeding ticket is part of, just part of the job. Well, I'm sorry, that's not deductible. You
can't deduct that.
So, and although, it's probably a hazard of the job, occupational hazard, but that's fines and penalties aren't deductible. So we kind of have to watch for those.
James just called in, by the way, and James, thank you so much for watching us here on Life Ahead. Here's what James wants to know. He said, when it comes to filing taxes, what is the difference between an IRA and a Roth IRA? Let's talk about that.
Well, a traditional IRA is taxable when it comes out. It's taxed as ordinary income, and you'll receive a 1099-R.
When you withdraw it.
When you withdraw it, right. The only exception to that is if you're old enough, 70 and a half, and if you can give a charitable contribution directly from your IRA.
Just have it transferred directly from wherever you have the Roth IRA to
not the Roth, the traditional IRA.
Or the traditional.
Then you don't have to do it. You don't have to pay tax on it. Now, Roth IRA, by definition, isn't supposed to be taxable when you withdraw it. But there are certain parameters. You have to reach the correct age. Account had to be open for a certain period of time. But generally, the goal is Roth IRAs are not taxable when you withdraw them.
When are you taxed on them then?
Roth IRAs are never taxed.
Never taxed. Okay, I know that many financial advisors or CPAs or whatever will advise people to start contributing to a Roth IRA,
So
even
you
when they're young.
The reason that they're not taxed is that you put after-tax money in a Roth IRA. A traditional IRA,
that's why.
You can peel that off the top and not pay taxes on that. Stick it away. The Roth, after you've paid your tax bill, is when you fund the Roth.
But isn't there a limit? Was it $5,000 or something like that of what you could invest in a Roth IRA a year? No, I don't know.
There's limits depending on age, depending on income. For Roth IRA. But a really nice thing that a lot of companies are doing right now is they have the ability to do a Roth IRA contribution or a Roth contribution to their pension plan. So they can choose to be a Roth where they might not meet the income limits to do that. So we see a lot of that. And the younger they are, the better the idea is to put your money into a Roth.
And then just don't touch it. Just pretend it's not even there, but you'll be so excited when you're older and find out that you have that.
A great planning thing for people to do for their kids, to encourage savings and to encourage retirement is, your kids got, your high school kids got a part-time job somewhere and they earn $1,500. Well, you could put up to their earnings limit, you can put that in the IRA. So as a gift to them, you give them $1,500 and that's going to grow. Compounding is a wonderful thing to grow.
They'll be amazed.
Yeah.
And, it's one of the things we like to do here, and with our purpose of giving education and information, if you listen to some of the things that they're saying, it's advice that you can share with your siblings, with your parents, and with your children that will save them a lot of anguish and a lot of money throughout the years.
Right.
Okay, let's go back to taxes again here. How about 2023, because that's what a lot of people are doing right now, their taxes for 2023. What do they need to think of in terms of any changes there might be? Is there anything going on with the IRS?
Not a whole lot of changes.
Okay.
We're seeing, of course, the tax brackets change a little bit every year. So, and those are built into our software, so there's typically no surprises coming from that end. The thing that has changed recently is, and it's kind of related to taxes, but not a part of taxes.
Okay.
There is something out there that became effective January 1st of 2024. It's called the Corporate Transparency Act and Beneficial Ownership Interests.
Say it again.
Corporate Transparency Act.
Transparency Act.
Yeah,
Okay.
and it is a way for FinCEN, and that acronym is for Financial Crimes Network, find out who owns what kind of companies. So they're looking for shell companies. They're looking for, basically what they're looking for is money laundering. And so they want to know what type of entity you have. It's been proposed for quite some time, but the reporting requirements just started in this year. But somebody took it to court and it was declared unconstitutional this past Friday.
Oh, really?
Oh, really?
Yes.
So what happens then?
So now it's kind of on hold, and maybe we don't have to do the reporting requirements. But,
for 2023 even, though.
Right.
Okay.
Well, it was effective January 1 of 24.
Oh, I see.
So,
all right. Yeah.
But that's something that accountants
have to know.
Can't really help our clients do. We're referring it to the
Legally.
attorneys to do it. Yeah.
Have you had that issue yet, Heidi?
Yeah, we've been all up in arms in our office trying to figure out how best to inform clients of this and assist them with it. So, yeah, I was not aware of that.
That just happened. That just happened Friday.
I think you guys
in
need
Alabama.
to have a long chat here before you leave tonight. Heidi, how do you go about that? If there are major tax changes or estate changes or something like that, and you're dealing with them from a legal point of view, how do you go about informing people, or is it your responsibility?
It's really not a lawyer's responsibility to keep a client. It depends on how you've set up your engagement with your attorney, but in the way that I work, it's your responsibility to come back to me.
Yeah.
I try to do informative things like through these shows or articles that I write to get information out there, but there's just no way that we can contact every client that we have to say this is a change that might affect you.
Right. Because there are so many and have so many clients, and then that changes again. And, which is another reason, and I know you counsel our viewers to have a meeting with your lawyer every now and then.
Every
How often?
few years, 3 to 5 years, or a big life change occurs. or you're really big, I'm retiring this
Yeah.
year, I've
A
been
major
diagnosed with
change.
an illness, those are the times when you really want to check in.
Right. And maybe there have been changes even when you're younger. I mean, maybe
Right.
you're all of a sudden you're a part of a blended family,
Yes.
or things that might
And
change.
it seems like what we do is, boring or not exciting.
I don't think it is.
But
It's the core of what
yeah,
our lives
we're
are
just
about.
paperwork the government invented, but really, I mean, we're paying attention, reading articles all the time,
Yeah.
and in our world, we do get excited. Things do change. So,
Seeing like the issue
Yeah,
that you
I
just
know,
discovered.
I know.
Yeah,
We're-
that's pretty darn exciting.
Yeah.
You have 5 minutes left, by the way, if you want to give us a call real quick here with any questions you might have. Heidi, let's go back to you as far as, or Cindy rather, let's go back to you as far as the taxes. So nothing new about 2023 that people out there don't know.
Well, something new on Indiana taxes. A lot of people are interested in donating to Indiana 529 plans for their kids or grandkids' education.
Yeah.
And the limit used to be 20% of the first $5,000 you contributed, you got a state tax credit.
Okay.
That went up to $7,500 this year. So 20% of $7,500 is your tax credit. But they also have now said that you could make a contribution to a 529 plan for 23 right now up into the due date of the return, and they've never let you do that before.
Okay, so up until mid-April, we can
Right, April
make that
15th.
contribution.
Right, you can make that contribution. So that's a new thing this year.
Okay, that's kind of important. That could be significant.
People could take advantage of it if they wanted to.
Okay, I don't know which of you can answer this question, but you talked about 529s for children for their education. Does the grandchild have to be any specific age? Can it be a newborn? Does it have to be a teenager? What's the rule? Anything?
any age.
Any age.
Any age. Okay.
Yeah.
All right. Up to any certain age?
No, no, actually.
Oh, that's great. And what a gift. You know,
Yeah.
what a wonderful, wonderful gift, and you, as a taxpayer benefit from it as well. Okay, now, Heidi, as far as estate tax or trust, are there any tax consequences that people need to know about when they're doing their estate planning other than what a CPA is going to help them with?
Yeah, I mean, at this point, the federal estate tax limit is in excess of $13 million.
Well, I don't
so
know.
it impacts fewer and fewer people.
If you're in that category, call us. We want to know you.
Yeah.
We want to be your
Right.
new cousin or
Right.
something.
We want to be adopted.
Yeah. But something to be aware of is that $13 million exemption, unless Congress extends it after 2025, so starting in January of 2026,
Okay.
the exemption is slated to come back down.
Oh, considerably, do you think?
Yeah, it's going to start at about $5.5 million, which will be indexed for inflation. They think it may land at about 7.
Okay.
So if you are a person between the 17 million and the 13 million, you may want to check in with your attorney over the next year because you may want to consider some things.
Okay. All right. Good tip for
Yeah.
sure. Okay. Estimated tax payments. Good idea or not? What do you think?
They're required if you owe more than $1,000.
Okay.
So you're required to do it. The IRS has.
I mean, if you're not working anymore, if you're not working.
Still, IRS says as you get your money, we get our share.
Okay.
So you have to pay that quarterly. You can figure them a fairly common way
Yeah.
to do it is to at least cover your prior year's tax so that if this year it ends up that you owe a lot, at least you won't have an underpayment penalty.
But again, you don't get notified every quarter. You have to be responsible yourself.
Yeah, you do. We give you most offices, they're going to give you a letter that says, here's what you owe, here's the
what it's
coupon, send
due.
it in, here's your coupons for your estimated tax payments, send it in. I will say there's a couple of clients I probably do call, but I can't
To remind
possibly
them.
call all of them.
Right.
And this year, because underpayment penalties are based on prevailing interest rates, and we have all seen interest rates go way up through the roof for some things. So we're seeing that there's a little bit more substantial underpayment penalties this year. There are ways to get out of it, but it's a little bit more, you have to jump through a few more hoops. So you're required, so it's a good idea, especially when you transition for working to retirement, to set those up.
Well, I just appreciate the information. Our half hour has gone so quickly, unfortunately, because there's so much more information that we could share with you. But we hope you've benefited from some of the things that Heidi and Cindy have been able to share with you. And I think the bottom line, from what I'm hearing, if we had to summarize both of you, is you have to be responsible for yourself. They will help you with legal or financial advice, but listen to them and then do what they tell you in a timely manner. Well, speaking of time, we're going to see you at 7:30 right here again next Wednesday. And meanwhile, I want you to stay healthy and stay happy. Good night.
The preceding program on PBS Fort Wayne was made possible in part by
Beers Mallers, elder law attorneys providing information on legal matters of guardianship and financial issues relating to nursing home care. Beers Mallers attorneys can also assist with Medicaid requirements and help navigate difficult family situations. Offices in Fort Wayne, LaGrange, Warsaw, and online at beersmallers.com.